I'm Wei Lynn, this is the HTV, and I'm here at the Affin Hwang Capital Conference Series 2015. With me today is Mr. Ong Boon Leong, Head of Research at Affin Hwang Capital, who will share with us the outlook of the Malaysian stock market this year. Thank you for being here with us, Mr. Ong.
Thank you.
Today's conference, the theme is Navigating Through Turbulent Times. Could you share with us what's your outlook on the local stock market this year?
Okay. Well, for the first half, we think that it's going to be volatile, it's going to be uncertain. That's primarily driven by volatilities in oil prices. Yeah. So we think that could stabilize towards the middle of the year, and then we'll probably be getting more upside in the market in the second half. There should be more clarity in terms of the direction of the market and direction of earnings once the volatility is going to subside. Yeah. So a better second half.
Now, with a better second half, or for the rest of the year, for the full year actually, what are the key themes or sectors that investors should be watching out for? Second half.
Right. For the first half, we advocate staying on the defensive. Yeah. Because of the volatility. If the share prices will come off, we suggest bottom fishing quality stocks. For the defensive sectors, we like the selectively telecommunication stocks, consumer stocks, even the REITs that give good yields are preferred. Yeah. For the second half, we think that there will be more construction infrastructure activity. We may see more news flow for the infrastructure and construction sector. So that would be a positive sign for the market.
Within the few sectors that you mentioned for the first and second half, could you perhaps name a few stocks within, say, for the first half like consumer or telcos, and the second half like construction, a few stocks that Affin Hwang Capital is bullish?
For the first half on the defensive side, we like Astro. We like it for its recurring revenue, recurring earnings, visible dividend policy. We think the stock is undervalued. Yeah, so that's on the defensive side. For the construction sector, we like IGM Corporation. We like it for continuing news flow from potentially more government projects coming out. So that would be positive for IGM.
You don't foresee any delays in the construction side in terms of the contracts given out, even in the second half?
Well,
be delayed to next year.
Never rule out those type of things, but we think that given the state of uncertainties and volatilities in the market, and the risk of potentially slowing or smaller economic growth, that government would try to push ahead with more infrastructure projects. There will be more emphasis on infrastructure and construction sector. As you know from the amended budget 2015, the government has reiterated its development expenditure that hasn't been cut. And then looking into towards the middle of the year, we're expecting the 11th Malaysia plan. Again, that is more focus on the construction and infrastructure sector.
Now a little bit on the corporate earnings. This is versus valuations. Have they been keeping up with valuations? And what kind of earnings do you foresee Malaysian corporates to achieve this year?
Earnings hasn't really been keeping up with valuations. Over the last few years, we've seen a lot of earnings cut on a quarter-to-quarter basis. So in terms of valuation, we think the market had already reflected quite a bit of the downside on that. But the risk is still remaining, whether there could be potentially more earnings cuts on a quarterly basis going forward. That's still that is in fact one of the biggest, or one of the key risks that we see for our market.
On a regional front, how does the KLCI today fare compared to its neighbouring peers?
We've come down quite a bit. Compared to, say, the average PE for the TIP markets, Thailand, Indonesia, and the Philippines, Malaysia is pretty much at par compared to the average TIP PEs. As you know, Malaysia had historically been deemed as pricier, or more expensive market. But after the sell down sometime around November, December, our valuation is quite comparable to the regional peers.
Historically, on a 10-year front, Malaysia, the KLCI, is it still considered, not comparing to its peers, but on its own, KLCI, is it still considered expensive?
No, compared to its historical average, Malaysia is not expensive.
Thank you so much for your time, Mr. Ong.
Thank you.
That was Mr. Ong Boon Leong, Head of Research at Affin Hwang Capital, who is of the view that the outlook for the Malaysian stock market will be better in the second half of this year. I'm Wei Lynn, you've been watching the HTV.